Washington is attacking retirement savings. In this educational episode, I'm going to be talking about how Congress is being forced, because of irresponsible spending and the printing of money, to raise income taxes, taxes on capital gains, estate taxes, corporate taxes, which causes inflation because corporations have to raise the price of their goods and services or lay off people, and that creates unemployment. They have created a huge mess. I'm going to show you what you can do to make yourself immune from this mess that the government now is going to try to correct by raising taxes, printing money, which causes market volatility and will head us into a recession. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for nearly 5 decades, helping people optimize assets and minimize taxes. And my favorite financial instrument, if you've watched very many videos on this channel, is a max-funded indexed insurance contract structured correctly and funded properly. And it eliminates the dangers that I was just alluding to: taxes, inflation, and market volatility. So let me explain why and how. I feel sorry because so many taxpayers are like this ostrich with its head in the sand, because it's going to be open season with the IRS. And when they spend more than they bring in, that's what the government seems to do, is raise more and more taxes to be able to cover that deficit spending. Now, I want you to know that I'm not a doomsdayer. And so when I recorded this video and I said Washington is attacking retirement savings, I want you to know it's not that I'm a doomsdayer, but I am a realist. Hello, just look at what's happening. Face the reality of what's going on. I hear people say, I can't wait until things get back to normal. Well, get used to different, because it's never going to turn back to whatever you thought normal was prior to COVID-19, because they did some things because of COVID-19 as far as spending and printing money that has never occurred before in the history of America. And in my opinion, it's not going to be pretty trying to dig their way out of it. So what can you do? My take is this: if your retirement savings are invested in the market, in tax-deferred accounts, like IRAs and 401ks or the like, I would recommend you reposition that money and protect it from losses now, sooner than later. And that would be into IUL if I were you. So many times I ask people, is postponing tax a good idea? Because when people would come to me with their IRAs or 401ks approaching retirement, they would look at it like it was this sumptuous Subway hoagie sandwich depicted here on the left, but that's before tax. I would tell them to bring their after-tax IRA or 401k statements with them. I knew they didn't have them. And so I said, I'll have to calculate it. And then it would look like this. The $1 million nest egg in their IRAs or 401ks was only worth about $650,000. That was their money. The rest of it had a permanent tax lien on it based upon Uncle Sam. In other words, I would say, have you been planning your retirement or Uncle Sam's? Because a third of that money belongs to the government. If you have $1 million nest egg, and you pull out 10% a year, $100,000, you're only netting $65,000 or $70,000 to buy gas, groceries, prescriptions, and golf green fees. Can you get by on that much? If you can, well, you better watch out, because in about 5 years, you're going to need to pull out $140,000 to buy the same gallons of gas and loaves of bread that $70,000 bought 5 years ago because of inflation. And so this is what we call the tax and inflation power curve. But what drives me crazy is I teach a lot of CPAs and tax attorneys, and golly, it drives me crazy when they go, well, what the public doesn't know won't hurt them. Oh, yes, it will. In other words, they oh, did I tell you about the parachute of how you could have weathered that recession? You know, that poor taxpayer is just left without any protection. And I train them, and they go, Doug, we don't have time to educate people like you do. Well, that is sad, because you need to have a proactive advisor that will help you prevent these. So Biden's tax proposals, if you've been watching them, he attempted to do a lot of these, but this is on the agenda. He has to do these. Increase income taxes, reduce the 401k tax benefits for higher income earners, increase capital gain tax. He wants to really double them. He only increased them by 25%. He wants to increase the estate tax by 50% because they love to tax people that are 6 feet under because they can't complain. Okay, increase corporate tax from 21 to 28%. People say that's only 7% more. No, it isn't. It's 33% more. If a corporation on $1 million of profit paid $210,000 in tax under a 21% rate, now they pay $280,000 in tax. That's $70,000 more. $70,000 is 33% more than $210,000. And corporations, people say, well, corporations can afford it. No, not unless they lay off people and increase the price of goods and services. And then the government wonders why things are inflating. They don't get it. They've never run a candy store before. They don't understand economics 101. It doesn't matter if you raise minimum wages to 15 or 20 bucks an hour because that's all gobbled up at the gas pump or the hamburger stand. You do away with the IRA to Roth rollovers. I can't understand why they want to do that, but that's in the proposals. The healthcare initiative, student loan debt forgiveness. What are they thinking of? Those initiatives right there, those last two, are estimated to cost $10 trillion in the next decade each. Where are they going to come up with the money? Okay. Well, folks, there's 3 types of income Americans pay income tax on since 1986 tax reform. Earned income, salaries or wages. Passive income, that would be like rental or lease income. And then portfolio income, that would be interest or dividends. That shows up on the front page of your 1040 tax return. My favorite vehicle, max-funded IUL. When I take out income, $1 million of cash value can generate $100,000 a year of tax-free income. It's tax-free basically because it's not deemed earned, passive, or portfolio income. The IRS knows I'm receiving that, but they know it's tax-free. It's been tax-free for 108 years. It's been a sacred cow in the Internal Revenue Code for over a century. So when people come through our educational experiences, our seminars and our webinars, I usually talk about 4 different places that a lot of Americans can draw from for retirement. Not everybody draws from all 4, but investment, real estate, maybe guaranteed income or tax-free income. This is the most underutilized, is the tax-free. So to give you some examples here, the purple bucket, this is where probably most Americans are way too top-heavy in their retirement savings. They have a whole bunch of money, most of their money, and yet to be taxed, IRAs or 401ks. And I go, what were you thinking? You should have no more than 30% of your retirement coming out of that bucket. So that requires you get the money out in a strategic rollout, not a rollover. You're not rolling money over from a 401k to an IRA and continuing to defer, procrastinate until you're age 72 and then taking RMDs, required minimum distributions. That's the worst advice for most Americans. And yet that's what most of these advisors tell you to do. No, you're actually compounding the tax. Some people have real estate, but I recommend no more than 30% of your income should come from real estate because the real estate market's going to be affected. And if you have vacancies and those values go down, you're going to be in trouble. Some people like guaranteed income, Social Security, or a defined benefit pension. If you're a school teacher, that's okay. But this is the most underutilized. I'd recommend that 40 to 60% or more of your income not even show up on the front page of your 1040 tax return. The IRS will know you're receiving it, but I've had couples who have come through and we perform a strategic rollout. I had a couple that had $2.6 million here in this purple bucket, and they thought, we have $160,000 a year of income we can realize out of our IRAs or 401ks at a 6% payout. And they had another $40,000 coming from the orange bucket from a school teacher pension. I said, well, one big problem, it's all showing up on the front page of your 1040 tax return. They said, there's another way. And I go, yeah. In 5 years, we got 60% of the money out of here down to here. Basically, they still have $200,000 of income, actually more than that, because we're doing better with their money. But $200,000 of income, but $120,000 of that annual income doesn't even show up on the front page of their 1040 tax return. The IRS knows they're receiving it, but it's tax-free because it's not deemed earned, passive, or portfolio income. If you calculate the tax we save them every year out to the husband's life expectancy and the wife's life expectancy, We saved them $1 million of unnecessary tax doing this, moving from the purple bucket down to the green one. We do this all the time. That's what I would recommend you check out because of the government attacking retirement savings. When they are running short on money, they go to the people who have the money. And it's the people who saved, unfortunately. And so I'd recommend no more than 30% of your money be there, 30% here, maybe 0 to 80% if you're really super conservative, up to 80% be guaranteed. But I'd recommend 40 to 60% of your income be totally tax-free. So let's just talk about inflation here. Back in the early 1980s, the government, when inflation hit 10%, double digit, they realized they couldn't afford to pay Social Security recipients and retirees the real cost of living increase. And so they changed the way they reported inflation. They changed it from comparing the same basket of goods to the identical basket of goods year to year. It went from apples to oranges. They could compare the price of steak last year to the same 8 ounces of hamburger the next year. And they've been doing it. This chart shows the reported rate of inflation in the red, and here's the actual cost of living in the blue. And so the actual rate of inflation is usually double or triple whatever the government reports. So, for example, in the year 2022, when they said inflation was 8.9%, it was over 25%. So you have to link your returns to the things that inflate. Most of our clients earn 25 or 61%. When inflation's 15%, what happens? Well, rule of 72 will tell you at 5% inflation, divided into 72, the cost of living doubles every 15 years. At 7.2, it doubles every 10 years. At 10%, it doubles every 7.2. At 12%, every 6 years. The rate of inflation has been at least 15%. That means the cost of living will double in 4.8 years. So if you think you can get by on $100,000 a year, you better be ready, because in less than 5 years, you're going to need $200,000 a year to buy the same gallons of gas and loaves of bread that 100,000 bought 5 years earlier. Maybe today, in 5 years, you're going to need twice as much. This is what causes most people to outlive their money. So what's the solution? I have this weaponry, this ammunition that'll help you fight the battles of life. Don't put your head in the sand like that taxpayer in the beginning here. I want you to learn about these. And so many times we have the USS economy, which is like a sinking ship right now. And many times our congressional, revenuers are rearranging deck chairs, passing legislation, spending, trying to spend their way out of the recession. Hello, if your outgo exceeds your income, your upkeep will become your downfall. I wouldn't recommend that. I want to help you board a lifeboat. This is why on this channel, Three-Dimensional Wealth, I want to teach you strategies that will keep you afloat, financially speaking, in case this economy starts to sink, because I think it will. And so to help you board this lifeboat, you need to learn some things. And one of the big ahas is that, a 401k is not the cat's meow we thought it was. And you need to do something that's better. You're not going to meet a lower tax bracket, and you need to come to this realization that Uncle Sam is going to have to take a bigger and bigger piece of the American taxpayer's pie. Knowing that, you need to convert to tax-free, okay? Because these congressional legislators are slowing down what could otherwise be a robust economy, because they're trying to keep things under control because they've been printing and spending. And so they raise interest rates to try to slow down the economy, and it works against them, and they create a recession in the process. Is this making sense? Enough. Okay, so folks, what I'm trying to encourage you to do, protect yourself. Now, the first step is I want you to study this book. It's called The Laser Fund. It's a 300-page book. And you don't have to read word for word. In fact, it's 2 books in one. This one is for the left brain learner. It's 200 pages, 14 chapters with all the charts and graphs and explanations, and it comes in 3 different depths. If you want to really get to the nitty-gritty, you can read all 14. Otherwise, you just read the middle chapters, whatever you want to do. This is for the left brain learner. If you're more of a right brain learner, you flip it over to this one. This is 12 chapters, about 100 pages, with 62 actual client stories of how a properly structured indexed universal life insurance contract can be the dream solution for all kinds of goals, such as retirement, college funding for your kids and grandkids, working capital for your business, real estate management, emergency funds, pension maximization, if you're a school teacher, whatever. But it's the dream solution. If you want to use your whole brain, then read the Left Brain and the Right Brain book, both, okay? Now, here's how you can obtain a copy. You can go to Amazon, and they're $20, and if you purchase on Amazon, thank you, but I'll gift you a copy, free. Here's how you claim your free copy. Simply go to laserfund, L-A-S-E-R, fund.com, or click on the link below, and you contribute a nominal amount towards the shipping and handling. I require a little skin in the game, but I'll pay for the book. I'll fire out a hard copy to you via priority mail, and when you're in there claiming your free copy, check out if you like to listen and learn or watch and learn. There's audio and video available for learning. Check out the educational webinars we teach on a regular basis. They're free. But also you can schedule an appointment to talk to an IUL specialist that I've trained that will help you see an illustration of how a properly structured IUL may work in your particular set of circumstances. There's no cost or obligation if you choose to do that. This is not about me. This is about you and your brighter future and protecting yourself from Washington's attack on your retirement savings.